Good morning. Thank you for joining us for this webinar on 2020 taxes. I'm your moderator, Renee Goodnow from the New York Small Business Development Center. If you have any questions as we go, please don't hesitate to type them in the questions box as they come up, and we'll answer them as we go as well as at the end. You can also use the chat feature. Dennis will be keeping an eye on that, so that's another option for you to communicate with the team. Today's host is the Canton Small Business Development Center, and joining us to introduce our presenters and lead things off is Angela Smith, Assistant Director for the SUNY Canton SBDC. With that, I'll turn things over to you, Angela, to introduce our panelists and get things started.
Absolutely. Thank you so much, Renee. Welcome, everybody, to today's webinar, Tax Planning in a Pandemic Year. As Renee mentioned, my name is Angela Smith. I'm the Assistant Director with the SUNY Canton Small Business Development Center. For those of you who may not be familiar with the SBDC program, the New York SBDC is a network of 22 campus-based centers with dozens of outreach offices. We provide free business counseling to startups, entrepreneurs, and small business owners. Our services are free and are made possible by the funding we receive from the U.S. Small Business Administration, the state of New York, and our host campuses. Our two offices serve the North Country regions, which is 7 counties, basically located from the Canadian border all the way to Lake George. We are located on the campus of SUNY Canton and Clinton Community College. We have our team of advisors and disaster assistance counselors are available and working full-time, virtually. To find a center that's closest to you or to get started, you can request an appointment at newyorksbdc.org, and I'm sure Renee will put that link up on the presentation a little bit later. We have over 100 people registered for today's webinar, so it really shows the importance of this topic. Managing a small business is always a challenge, but in 2020, it has tested the limits for many. Managing COVID and all other family/work, remote work issues, it's been quite the year. Navigating PPP and EIDL and now understanding tax implications is critical to the survival of many. I am very pleased to bring in the experts today to help tackle these questions. So welcome Doug Hoffman, Certified Public Accountant, and Dennis Vincencio from the Hoffman Eells Group CPAs. We'll talk about PPP and share tax saving tips and, yes, answer your questions. As Renee mentioned, please use the chat box to submit questions. We'll do our best to answer them throughout the presentation, and we'll also stay back for about 30 minutes after the presentation to answer questions we may not be able to get to during the broadcast. Without any further ado, I would like to welcome Doug Hoffman from the Hoffman Eells Group. Doug, thank you for agreeing to do this presentation today, and thank you for supporting small businesses. So, welcome.
Thank you, Angela. And we're going to start out with Dennis.
Good morning, everybody. My name is Dennis Vincencio. I am a business coach with the Hoffman Eells Group, CFO to Grow. Our website is businessprofittogrow.com. We specialize in helping small businesses not only manage their business, start a business, and grow their business. Go to the next page. So a little bit about who we are. Our main presenter today is going to be Doug Hoffman. Technology.
Yes,
so
you got it.
Doug is the former managing partner of the Hoffman Eells Group. We're the premier accounting firm in Northern New York with 4 offices in Northern New York. Doug's got 47 years experience as a CPA, MBA, certified business coach and speaker. Also the founder of CFO to Grow, which we provide financial marketing, strategic business consulting and coaching services, as well as virtual part-time CFO, controller and accounting services. A little bit about me. My name is Dennis Vincencio. I'm a business coach. I have 35 years experience in small businesses as a CFO and a controller in the retail, construction, and manufacturing industry. And again, like Angela said, with no further ado, I'm going to turn it over to our resident expert, Doug Hoffman. I will be monitoring the chat. If you have questions, like Renee said, either in the question box or the chat, we'll try to answer as many as we can. And take it away, Doug.
Okay, thank you, Dennis and Angela, and glad to be on today to help everybody plan for the year end. This has been a very difficult year for everybody, and hopefully better times are coming with the vaccine coming out, and hopefully 2021 will be a rebound for everybody. But let's talk today about how we can plan for this year end and things that we could do to hopefully mitigate your tax consequences of this year. The goal of our presentation today is to give business owners some tools and concepts they can use for planning purposes. We want you to have some information, but this information is generalized, and every business has some specific considerations when applying these tools and concepts. So keep in mind that this is general tax advice and recommendations, and be sure to consult your tax accountant for specific advice, because every business is different. This isn't one size fits all. You need to make sure that your specific situation, you can use these tips, and so be sure to get the advice from your tax accountant whether or not you should go ahead with what you hear today. All right, so the game plan for the topics today, we're going to talk about the Paycheck Protection Program, the famous PPP that changes with the wind. We're going to talk about EIDL loans, economic injury disaster loans that you got from the SBA this year. We're going to talk about PUA tax implications, that's unemployment for self-employed people. Tax credits, the COVID and previous tax credits that are available. End of the year tax strategies, such as Section 179, repairs and maintenance deduction, home office deductions, and active real estate participants, what is available for you in the tax law. Retirement plans for small business owners, and business entities and choices we'll brush over just to show you some of the tax advantages of each of those. All right, so let's start off with the PPP loan forgiveness taxation issues. This has been an ever evolving issue, which anybody that got a PPP loan, you probably know that in the beginning, the rules were changing daily. And then as the year went on, we had weekly and monthly changes. And the IRS just 2 weeks ago came out with a ruling on how they were going to look at the taxation of PPP loan forgiveness. Proceeds, what the IRS and the SBA has been saying all along is that the proceeds from the forgiven portions of the PP loans will not be taxed, but stay tuned. The EIDL advance is considered a grant and not forgiven under the PPP loan. For example, if you got a $50,000 PPP loan and $6,000 as an advance under the EIDL loans, only $44,000 of the PPP can be forgiven. That's the $50,000 minus the $6,000 advance. And what I'm talking about, the advance is not the EID loan, but you're eligible for $10,000 up to $10,000, and what they awarded was $1,000 per employee. So if you had 6 employees, you would have gotten $6,000 advance on the EIDL loan. Now, if you subsequently got a full EIDL loan later, that portion is not deducted from the PPP loan. It's only the advance that you received. And here's the bad news under the PPP. The expenses that you paid with the PPP loan that are forgiven are not deductible. And we'll show you an example of that later. If a business believes that the PPP will be forgiven in the future, the expenses related to the loan are not deductible in 2020. So even if you haven't applied for forgiveness and you won't apply until 2021, the expenses, according to the IRS, and this was their latest ruling a couple weeks ago, says that the 2020 expenses that you paid with the PPP loan that will ultimately be forgiven are not deductible in 2020. Does not matter if the loan forgiveness has not been filed in 2020, you still cannot deduct the expenses in 2020. All right, so the EIDL loan does not have any special treatment. As I said, anything above the advance is not taxable, but the advance portion will be considered taxable income in 2020. So if you got 1,000 or up to the 10,000, depending on the number of employees, that amount is considered taxable. The EIDL advances that advance that you got, the expenses that you paid with that, they are deductible. So it's the opposite of the PPP. And however, the IRS has not come out with a final ruling on that. So stay tuned before you file your tax return. I'm sure your tax advisor will keep an eye on that and let you know if that changes. And as I said, with the PPP and the EIDL, it's a moving target. So if something else comes out after this presentation, your tax advisor will more than likely be aware of that. All right, so here's an example that we want to show. Same thing we talked about before. This business got a $50,000 PPP loan, and they got a $6,000 EIDL advance grant. So their net income before the PPP and EIDL advance was $40,000. And this chart just assumes a tax rate. Everybody's going to have a different tax rate. But for sole proprietors and partnership, we're looking at a potential tax rate of 35%. So they would owe $12,000 on that 40,000. And again, that's an assumed rate. Your rate could be lower or higher than that. If it's an S corporation, their rate is lower than the sole proprietor and partnership because their tax on their income that goes onto your personal income tax return is not subject to the self-employment tax. Now, self-employment tax is your Medicare and Social Security contribution. And as a sole proprietor or partnership, you're paying both the employee and the employer portion. So that's 15.3%. And so that's why you see the difference in the tax rate between the sole proprietorships and the partnerships, different than the S corporations. So the S corporations would owe $6,400 on that profit net income. Now, going back to the calculation, we have to add in the forgiveness portion of the PPP loan. Remember, that was 50,000 minus the 6,000 advance EIDL grant. So that's 44. And then that advance portion of the grant is taxable. So you add that in at $6,000. So the taxable income for this particular business becomes 90,000. It, by the way, pushes them into a higher tax bracket. So they're going to owe an overall 40%, and the tax on that is $31,770. If you go and calculate that, that's a little different than 40,000 times the 90 for two different reasons, because the 90,000 is subject to the full self-employment tax, which is 15.3%. But under the new tax law, the income tax You get a 20% deduction, maybe, because the IRS law always includes if, ands, or buts. But if you got the full 20% deduction that the law allows, you'd only have income tax taxable on that at 72,000 because of the 20% deduction. And so anyway, take my word for it, the tax on that would be 31,770. Same thing on the S corporation. They don't have, again, the self-employment tax, but they have regular income tax, and we assumed a tax bracket for federal and state of 25%. And on they do get the 20% discount too on the taxable income. So on $72,000 taxable income, after the 20% deduction, they had to pay $18,000. Now I know this is all confusing, but just the point that we want to make here is that for purposes of planning for the year end, it's not just your net income that you're looking at in your books. You are going to have to add in the loan forgiveness under the PPP, plus the advanced portion of the EIDL loan. And the point we want to make here is that you need to look at some deductions that you can take to offset that this year by the year end, or anything that's available after year end, such as pension contributions, to mitigate this amount of tax that you're going to be paying on the additional income that's going to be taxable. So this is what we want to plan for today. So some
Hey,
people
Doug,
might.
we had a quick question that came in. Does this mean that forgiven PPP money is effectively viewed as income?
Yes. Yes, because, even though the IRS or the SBA says it's not taxable, the IRS agrees it's not taxable, but they're saying that you can't deduct the expenses. So in effect, it is taxable. It's just government double speak,
Thank
unfortunately.
you. And thank you, Josh, for that question.
Very good. So yes, that is the bottom line, unfortunately. And so some people might be asking, well, what if my loan is not forgiven, or I decide to pay back the loan and not ask for forgiveness? First of all, I want to point out, be very careful in selecting that. Somebody may want to do that. For example, if they figure out that they can get more under tax credits, otherwise they may decide to pay back the loan. But in general, it is too bad that you're going to pay taxes on this. But if you get $50,000 in the PPP and combined with the EIDL advance becomes taxable, even if you're in the 40% bracket, you still get 60% extra money by having it forgiven. So it's a shame that you are going to have to pay taxes on it, but you're going to have more left in your pocket by going for forgiveness and paying the taxes than you would if you decided to pay it back. So keep that in mind. But if you, for some reason, you and your tax advisor decides it's best for you to pay back the loan, the IRS revenue procedure says that you have three options. If you decide that before you file your tax return, including extensions, then you can deduct the expenses that were paid by the PPP loan. And you can deduct that currently on your 2020 tax return before you file that in either the final deadline with extension is October 15th for individuals, or September 15th for partnerships and corporations. If you already had filed your 2020 tax return, you can amend the return anytime within 3 years after you file it and claim those expenses. And The third option is you can take those deductions on your 2021 tax return. So again, your tax advisor will let you work with you to find out which one is these three options is best for you going forward.
Doug, before we get too far in this, one of the things that came up in one of the previous panel discussions we had, a banker mentioned that PPP loan forgiveness is not an all or nothing. So if you don't know or you think you're not going to get forgiven, you can apply and get a partial forgiveness. It doesn't have to be the full amount, was kind of the point everybody was making. So if you're unsure, bankers are saying apply and see if you will get even a part of it.
Right, and talking about the application process, you have 10 months after you make your final payment with the PPP loan proceeds to apply for the forgiveness in order to not have to start paying back the loan. But you have quite a long time after that to apply for it. The only problem is you'll have to start paying it back.
Right. It's up until the amount of the or the maturity date of the loan. Technically, you have all that time to say, I want to apply for forgiveness afterwards.
Right. Okay. So, Angela, did you have a question?
I think I might. So we don't know, but is it possible that in 2021, maybe some new tax laws to hopefully make PPP maybe less taxable for small business owners? Tax laws might change, right? We don't know. Would it be advisable for someone as a strategy to consider to maybe file an extension to wait and see what might happen?
Yeah, especially with the new administration coming in, you know, and even without the new administration coming in, it was the intention of Congress that this would not be taxable. And it was the IRS determination that the expenses would not be deductible. So Congress could overrule that. And, you know, if it comes up to April 15th and you hear rumblings about that, I would definitely suggest people file an amended return, or not amended, but an extension to see what Congress ultimately does. Certainly by September or October, we'll know for sure whether something like that's going to happen. But if you do file the extension, I would recommend you pay the amount that would be due in the worst case scenario, because you will receive penalties and interest if you don't pay by April 15th. And you want to make sure, we're going to talk about paying estimated taxes. You want to make sure that you paid enough into your estimated taxes that you're not going to be penalized up until April 15th.
Okay. Thank you, Doug. I think it's a question that's on a lot of people's mind. And as you and I discussed in prior groups, there's an administrative cost to managing these programs, right? Extra labor, tracking of data. And now if you file taxes and then have to file an amendment, those are potentially additional costs for small businesses. So we're just trying to, you know, think about strategies where people can keep more money in their pocket, and maybe working with your tax accountant, filing an extension is where it's at this year in case the tax laws change.
Right. Yeah, it's unfortunate that there's these administrative costs associated with these, and certainly as a tax accountant, we don't want to have to do an amended return and charge you for that. So the extension would be the most safe way of going about it. But, you know, still pay in what's due under the worst case scenario, and get the money back if the law does change.
Okay. Thank you so much for talking about this, Doug. I appreciate it.
You're very welcome. Thanks for the
Doug,
question.
here from the questions, we have one more follow-up to that. What would happen if you do use the PPP loan proceeds for non-deductible items?
You won't be forgiven. That portion won't be forgiven. And then you can deduct those expenses if it's not forgiven. It's only the amount of the PPP loan that's forgiven that you can't deduct the associated expenses.
Okay, great. Thank you for clarifying on that one, Doug.
Sure. All right, so what are your year-end steps? First of all, talk to your tax advisor, plan ahead, make an estimated tax payment. We just brought that up. You need to pay, depending on how much your 2019 estimated taxes were, in order to avoid the penalty. You have to pay at least 100% of your 2019 tax. And if you had higher income, it's 110%. And or 90% of your 2021 tax, 2020, your actual 2020 tax. So those are the three exceptions to an estimated tax penalty. The other thing about an estimated tax penalty is that you're supposed to make 4 of them during the year. So even if you load it up at the end of the year, you could receive a penalty for the first 3 payments. But the penalty isn't that severe. So if you miss the first 3, please feel free to sleep at night, because the penalties these days range from 1% to 2%. And it's only counted on the number of days that you are late on the estimated payment. One way to mitigate the penalty if you miss the first 3, you could do if you're going to do a bonus at the end of the year, you can put all the money in that bonus towards the tax withholdings. And the IRS looks at withheld income tax on a payroll item is spread over the entire year, not just when it's paid. The negative to that is you will pay Social Security and Medicare potentially on that bonus if you're under the 137,000 Social Security limit. And then consider year-end tax moves that can lower your taxable income, and stay tuned, because more of that advice is coming in this presentation. And one of the biggest things you can do by the end of the year is maximize your pension, 401k, or simple IRA contributions. And in some cases, you have to do that through payroll deductions. So make sure you do that by the end of the year.
Doug, we have another question here that I was typing an answer. I thought that probably I'd better ask you. So
okay.
If the law says it's not taxable, then if it is not filed in your taxes as income, then are you not breaking the law and can't be penalized? So I think what we're really saying is that because of the unclarity about how the Congress wrote the CARES Act, the IRS was able to issue a ruling on the taxability of that, right? Am I saying that right?
Yes, I think the question that the person is asking is, can you go ahead and file your tax return not showing it as income and not taking taking the expenses as a deduction? And the answer to that is the IRS has issued a ruling that the expenses aren't deductible. So if that's ultimately held up in tax court, because I can guarantee you somebody will be challenging it, then if you didn't file that directive from the IRS, they can penalize you for underpaying your income tax. And that penalty for negligence could be as high as 20 to 25%. So I don't think you want to play that game. And I don't think you want to be the one to take it to tax court and challenge it, because your tax lawyer that you hire is going to make more than that 25% penalty.
Okay.
Plus you have the 25% penalty on top of that if you lose in tax court. So let somebody else take it to tax court and then later on file an amended return and get a refund and have the IRS pay you interest. Unfortunately, you can't penalize the IRS though.
Doug, I'm going to layer in another question here while it's fresh. As a 501c3 organization received a PPP loan only, we anticipate it to be forgiven. Do we provide copies of all docs to our 990 Easy Tax Preparer?
Yeah, because because you don't pay income tax, the amounts that you paid with that PPP loan won't be deductible, but that isn't going to result in income tax to your organization unless you have unrelated business income. So a not-for-profit organization in some cases has a sub-business that is taxable. And if you do have that and you paid payroll or other rent or interest on that were not deductible or that were qualifying for your PPP loan forgiveness, then your unrelated business income could have a higher tax because of that. Proper planning, you could only submit, you can plan around that by submitting deductions that only apply to your exempt status and not to your unrelated business. So it's probably more than they wanted in that answer, but as I said, anything under the IRS is a if, and, or but, and you have to get specific advice from your tax advisor because of those if, and, or buts. Okay, any other questions?
Not so far, Doug.
All right, so that's possible actions that you can take, and let's get on to some tax moves that you can to try to lower your tax for 2020. All right, so one of the big things that you can do is increase expense payments before year end. You can look at your payroll, your supplies, etc. Fill up your fuel tanks, little things like that. It may not seem like a lot, but it could add up. And certainly if, depending on whether you're on a cash or accrual basis, cash basis taxpayers can only deduct what they pay for by the end of the year. Accrual basis taxpayers can deduct items that they pay in the first 2.5 months of the new year. Accrual means they have accounts payable and they can deduct whatever they have accrued by the end of the year in expenses. So that's the first tip, and that's a big one. And we'll get into more tips as we go on here. All right, let's talk about the other benefit that was available under the pandemic through Congress this year. And
Sure, Doug, before we jump into this one, can we ask one more PPP question?
Oh, absolutely, Renee. Thank you.
Thank you. And this might actually come up on the next couple of slides during the retirement, so I apologize if I'm jumping the gun on this one. Joshua's already maximized the 401ks. Am I able to use a new comparability profit sharing to also offset the PPP money that is being forgiven?
Yes, if your 401k has a profit sharing component to it, you can then do a profit sharing. But keep in mind that profit sharing has to be for all employees, not just the owners. So again, you want to get tax advice on that. And it's a good question because if you don't have the profit sharing component on your 401k, you may be able to add that by the end of the year. That I can't answer off the top of my head, but talk to your plan administrator and see if that's possible to do that, if that's something you want to do. And if you can do that, or you already have that component on your 401k plan, you have until the time you file your tax return, including extensions, to make that contribution. So that's a great way to mitigate the taxes. If you file for an extension, it gives you all the way up to September, October to see what Congress is doing, and then you can put the money in and get a deduction for that in making a final decision which way you're going. So that's a great question.
Great, thank you.
Sure. All right, well, let's get into PUA. What the heck is that? That's the Pandemic Unemployment Assistance. For the first time in history, self-employed people were eligible for unemployment benefits under the congressional legislation that was passed. This applies to self-employed people, people like Uber and Lyft, freelance programmers, handymen, independent contractors, impacted individuals who don't qualify for state unemployment. And unfortunately, I can't give you good news on that, so don't shoot the messenger. These benefits are taxable, and you will receive a 1099-G for these benefits, and they must be included in your gross income. Employers will have little to no effect on these because they go directly to the employee, and so they run through the employee. The thing I haven't seen yet, and I may have just missed it, is if you're self-employed, usually any income that you get is subject to the self-employment tax, and I keep bringing that up because that's a big hit, 15.3%. So the big question for you to watch out for and for your tax advisor to ultimately decide is whether or not this income, if you're self-employed, has to be added to your self-employment income, or if it's like any other unemployment, it goes on the front of your 1040 and it's not subject to self-employment income. So keep your eyes out for that. That's going to have a big impact as we go along. Dennis, did you see anything on that in your?
I didn't see anything in the research that I had done, so I think that's a good, there seems to be these open questions going forward that hopefully get cleared up soon, right?
Right, because that could have a big impact on self-employed people and whether or not it's going to have that 15.3% hit. Okay, let's jump from that into unemployment tax credits that came through legislation this year. And these are big benefits that everybody should be reviewing to see if you're eligible for it and if you should apply for these benefits if you haven't already. So the first program was the Sick and Family Leave Act. This gave credit for sick and family, for people that had to take time off because they were sick. And the eligibility is $511 per day up to 10 days or $5,100. And there was also something if you had people that had to stay home because somebody had the coronavirus. So if they were staying home and caring for someone with coronavirus, you could get $200 a day up to $2,000 if you paid for that sick time or paid leave for your employees. So it's either $2,000 or $5,110, depending on whether it was the employee that was sick or they had to stay home. Now, in addition to that, we know that people had to stay home because children weren't able to go to school and the daycares were closed. So if you did pay your employee when they were home doing that and they weren't working, keep in mind if these are just people that weren't able to work, if they were actually producing for you at home, this wouldn't qualify. But if they were home and not able to do their regular work, you can get that $2,000 for up to 10 days. $200 a day. The credit is for the full amount requested for sick and family leave. It can reduce your federal deposits, but that was to help you out as you're going along. But you know, between now and the end of the year, if you didn't get that, you could apply for the fourth quarter for the amounts that you paid all year long. So you could still get that money in your bank account by the end of the year by applying for that. Or you can go back and amend the prior quarter 941 tax returns to get that that credit in your bank account. So yes, you could apply for an advance amounts by the reduction in the deposits that you would have to make. And again, you still have time for the fourth quarter to do that.
Doug, these are available even if you got the PPP, is that correct?
That's correct. The next credit, the sick and family leave, is available for anybody, any business, including businesses that got the PPP loans and the EIDL advances. Now, this next credit is not available if you did get the PPP loan. And for the people that didn't get the PPP loan or were too late in applying and the money was gone, this is a big deal for you, so pay attention to this one. It's available for 50% of the employee wages, including any health insurance that you paid, up to $10,000 in wages. And so that equates to $5,000 per employee. That's the cap on it. And it could be, you know, it could make up for the fact that you didn't get the PPP loan because if you continue to pay wages, there's certain requirements. Your gross income has to be lower than 2019 for a certain period of time. And if that's the case, and you did retain employees, take a look at that, because that can put some money in your pocket by the end of the year. Okay, there's a lot of old credits that are available. I'm not going to go through them because they're very complicated and they're very unique to different businesses. But if you were getting credits in the past, make sure you take a look at those credits. A lot of people are weighing these credits against whether or not they should ask for PPP advance forgiveness because again, you want to work with your tax preparer to see which one is going to be more beneficial to you, the forgiveness or this credit. And a big example would be the research and development credit. I know I talked to one of my clients last month that was weighing which one would be better for them, because during the pandemic, when everything slowed down in their business, they did more research and development. And so with proper planning, though, you can have your cake and eat it. So I think that's enough said. Planning does work, and you could get both credits if you do plan properly. All right, let's get into more end of the year tax moves. And we're going to be talking about Section 179 deductions. This is very, very liberal under the new tax law that came out late in 2017. Most of you out there will never exceed this maximum, $1,040,000, but it's available dollar for dollar on purchases of furniture, fixtures, and equipment. And since 2017, some building improvements will qualify for immediate write-off. And that's a big, big, big deal. What improvements? Mainly interior building improvements for non-residential real estate property. So anything that's rented for residential rental, this would not qualify, but any commercial buildings that had building improvements, renovations done on the interior will qualify. it will not qualify for additions. So anything that will increase the square footage, those interior improvements would not qualify. But if you're just renovating an interior of an older building, you can write off dollar for dollar, which is a big deal. Also, any improvements with less than 20-year lives. Convenience store gas stations have a 15-year life. Some agricultural buildings have a 15-year life. So anything with less than a 20-year life would be available for that Section 179 deduction. This is an area where tax preparers sometimes underutilize the planning opportunities because you can take the deduction to reduce this year down to 0. You can't go below 0, but you can carry forward any unused deduction to future years. So just be aware of that opportunity. Bonus depreciation is in addition to Section 179 deductions, and the 2017 Tax Act increased this from 50% to 100% through 2023, and then it reduces down to 0 for the next few years. It's now eligible for used property. Prior legislation had it only for new property, and it's eligible for property with less than 20-year life. And so qualified improvement properties do fall into this category. However, watch out, because New York State does not allow bonus depreciation. They do allow Section 179, so take that first. For anybody out there that exceeds the $1,040,000, then you'd want to start looking at bonus depreciation. But keep in mind that that will only reduce federal income down, not New York State. You'll still have to depreciate those over the normal lifespan of the property. If you miss any of this in 2018 or 19, you can amend those tax returns and elect to take the Section 179 or the bonus depreciation. Be careful. Again, the if, and, or buts of the IRS is multiplied many times over in this section, in these two sections. You have many limitations, such as automobiles and others. So check with your tax advisor before you buy. Don't go out and buy and said Doug Hoffman said you can deduct this. I will not be held responsible. Okay. Repairs and maintenance is another area where the IRS has become very liberal on what you can deduct versus what has to be capitalized and depreciated or taken as Section 179 or bonus depreciation. These are very complicated rules, and a lot of tax preparers aren't up to date on a lot of these. So there are opportunities for amended returns or refunds. Another area that is very seldom used is cost segregation studies. This is where you go in and look at current and past depreciation on buildings, and you can separate these items into different components and depreciate them over shorter period of times than you would normally depreciate buildings. There's a very good opportunity for refunds and current deductions on depreciation that you missed in the past on these. It does cost money to do these cost segregation studies. You have to hire an engineering firm to come in and do it, but usually that cost is immaterial compared to the amount of tax savings that you can get for these. So keep that in mind if you have a building and you bought a building in the last 5 or 10 years, there could be some substantial income tax savings on this. Now, a big question that we get with the Pandemic, because everybody's working from home, can I deduct my home office? Well, again, it's the if, and, or buts of the IRS, and it depends. If you're an employee, I'm sorry, there's no deduction available. The 2017 tax law eliminated the employee expense deduction as itemized deductions. So unfortunately, there's no home office deduction available to employees. Only businesses and self-employed people can use it. It must be a separate area used exclusively for business. If you're working at your kitchen table, forget it. If you're working in your study and the kids' toys are in there, forget it, because that means that you're using it for personal use, and that disqualifies the business deduction. It has to be a total separate area of your house. It has to be used only for business. And I don't know if the IRS has cameras, but keep the kids out. All right, so under normal rules, it needs to be the only business location or justified use. Certainly if you're locked out of your office, that is a justified use. But again, see the above. And the other thing you want to keep in mind, for the pandemic, is that temporary use qualified? Maybe, maybe not. I think you'll be seeing some IRS rulings on that as we go forward. One thing I want you to keep aware of is that when you do use your home for business, if you someday want to take advantage of the $250,000 or $500,000 exclusion on the sale of your primary residence, if you took a business portion of your home in the past, you're going to have to recoup that, and that portion may not be deductible. And again, it's the if, and, or buts of the IRS law. All right, so let's, in the section 179 and the depreciation or the bonus depreciation, I talked about that vehicles may not qualify. Vehicles are filled with the if, and, or buts of the IRS. And we have this chart to show you some examples. If you take work vehicles such as vans and heavy duty trucks and 16 passenger vans, etc., or any vehicles that are over 6,000 pounds gross vehicle weight, you can take 100% of that under section 179, as long as it's purchased in 2020 and it's in use by 2020. So if you run out and buy a vehicle and you get that vehicle by December 31st and you use it for business on December 31st, you can take 100% of write-off if it's a work vehicle or it has gross loaded weight over 6,000 pounds. On bonus depreciation, the maximum you can take is $18,100 in the first year. And under the standard depreciation, the maximum you could take is $10,100. Now, the next class of vehicles is SUVs and crossover vehicles that are between 6,000 pounds and 14,000 pounds. These are your heavyweight SUVs and extended cab pickups. They can that have less than 6 feet of cargo space. The maximum section 179 you can take is 25,000. The bonus is 18,100, and the maximum standard depreciation is 10,100. Passenger trucks and vans that are under 6,000 pounds, the maximum 179 is 11,560. Bonus is the same as all the others. Passenger cars under 6,000 pounds is 11,160. And the bonus is 18.1. We might have a typo there between the passenger trucks, the 179. But anyway, those give you a rough idea of what you can deduct in the first year, and if you buy those by December 31st. Again, my rule of thumb is don't go out and spend money just to save taxes. Usually by paying the taxes, you'll have more money in the bank if you don't buy. But if you're planning to buy a vehicle early in 2021, then definitely accelerate it into 2020 and get these deductions. And keep in mind that these are all subject to the percentage of business use. It must be over 50% to qualify for Section 179. And, it must be new or used, but it must be new to you. So if you buy a vehicle used from a related party, you're not going to be eligible for the bonus or the Section 179. So
Thank you, Doug. We had a quick question from Angela, if I could interrupt you quick on the 179, and then I wanted to jump back on a couple other questions.
Right.
Sorry to interrupt.
Go ahead, Angela.
So is the 179 available to all small businesses, irrelevant of the legal structure? So sole proprietors, partnerships, or only corporations? What if yeah.
It's for everybody in business. The only exception is it's not available for rental property, residential rental property. So if you buy a stove for a residential rental property, you can't take Section 179 on it. And I already talked about improvements, interior improvements in residential doesn't apply.
Thank you, Doug. We had a few questions come in on retirement benefits. Do you want to answer those during the Q&A, or did you want to jump back to that section you just went over?
We're talking about retirement, so let's hold off and see if we answer that. And if not,
perfect.
ask them after that section, if that's okay.
That's perfect. Thank you, Doug.
Okay. Any other questions before we move on cars? Again, don't blame me if it's not deductible. Make sure you clarify with your tax advisor before you go out and spend that money on the vehicles or anything in planning on this.
Absolutely. Doug, we did get one from Christopher on the depreciation. You started to mention bonus depreciation and used vehicles. Can you talk about that again?
Okay, bonus depreciation, if you buy a used vehicle from somebody other than a related party or a related organization to you, you can take bonus depreciation on that in the first year. You're better off to take the Section 179 though first because of the fact that New York does not allow the bonus depreciation.
Great. I think we're good on questions for now.
Okay. So pass-through entities, this is very complicated too. But overall, if you have a sole proprietorship, a partnership, or an S corporation, remember in the example I talked about a 20% qualified business income deduction and calculating the taxable income on that. Now, again, if you're subject to self-employment tax, it doesn't reduce down the self-employment tax, but it does reduce down the income tax that you're going to pay. So it's if in the example that I had, they had a $40,000 income. I think after the PPP and everything, it was 90,000. So everything, all the ifs, ands, or buts aside, they should be entitled to an $18,000 deduction and coming down to $72,000 would be their taxable income that the income tax would be calculated on. But there's a lot of ifs, ands, or buts in there. It depends on the trade or business. It depends on how much income you have. There's specified service trade or businesses that don't get that deduction if their income is over $200,000 or $300,000. There's a lot of, it depends on whether you're married filing jointly or single or separate, filing separately. So I'm not going to get in all those, just know that they're available. And if you look at your tax return and you don't see a pure 20% deduction, it's because of the if, ands, or buts. If you had, you know, it's, for example, it's limited to your taxable income on your 1040. So if you go to that line and it's 0, then you have no section 1, section of the 20% deduction that we're talking about here. So, you know, and depending on what type of business it is, sometimes the wages to the shareholders are included, sometimes they're not. If it's a partnership, the guaranteed partners payments are excluded too. So be aware of the if, ands, or buts is the bottom line to that. And this is one area where active real estate participants do get a benefit. They get a 20% qualified business income deduction, but there's if, ands, or buts whether or not you're qualified for that. So just because you didn't get it doesn't mean your tax advisor screwed up. You have to meet minimum requirements and number of hours working on those real estate properties that you're claiming the 20% deduction on. So again, sometimes the tax preparers miss this. Other times you don't get it because you don't fit the rules. All right, retirement plans. Jumping into that very quickly. Most people, if they are not into a qualified retirement plan, will qualify for regular IRA deductions, but this is the lowest contribution limits of 6,000 to 7,000 depending on your age, and that's the amount that you can contribute. And you have two choices. A traditional, you get a deduction from your taxable income for any contributions, but anything you take out later on will be taxable. A Roth IRA, you don't get a current deduction on your tax return. The benefit is that you pay no taxes later on. The next level up is simple IRAs. They're very cost effective to run for the businesses. They have mid-range of contributions of 13,500 to 16,500. The upper limit is if you're over 50 years old, you can contribute more money. And, you know, these are available to most business owners, even if the employees don't participate. The problem with them is that they had to be set up before October 1st to have them qualified for 2020. Keep in mind that if you do have an active simple IRA program in effect, that you do have to make your contribution either through payroll deduction, depending on if you're on payroll, or if you're self-employed, you have to make it by January, the end of January, to get your contribution deductible. 401ks are cost effective too. They have higher contribution levels for owners, 19.5 to 26,000. Again, if you're over 50, and some 401ks do require a certain level of contributions by employees. Other have safe harbor provisions built into the plan, so you need to consult with your plan administrator and your tax advisor to see if you can make contributions there. Both the simple IRA and the 401k do have matching, employer matching components to them that could range anywhere from 3 to 4% or higher. And sometimes 401ks do have profit sharing components onto them that we talked about earlier. Now, the highest ones and the most complicated ones to manage, and they do cost money to manage, are conventional pension plans. You've heard of KEO plans, other pension plans. They do have higher level of contributions possible for owners. That could range from 57,000 to 72,000. But the problem with them is that it's one for all. If you're making a contribution for you, you have to make a contribution for all your employees at the same percentage level that you're contributing for you. So those are the levels that are available. And let's go back to the question that somebody raised under pension plans or retirement plans.
Absolutely. And Angela had one in the chat too. Is there still time to set up SEP plans?
Yes. Simplified employee pension plans can be set up, and there's still time to do that.
Thank you.
And the SEP and the KEO plans can be set up until you file your tax return, if I remember correctly off the top of my head. Again, talk to your tax advisor and any pension administrators that you work with.
Thank you. We had a two-part question from Greg. Can you discuss tax consequences of taking retirement benefits in 2019? Must be put back within 3 years to being treated as taxable income, was his question. And what if you're working for a New York company from non-income tax state or vice versa?
Well, let's answer the first question. So they took out money in 2019 that had to be paid back over 3 years. That was a special provision of the tax law that was available in 2019. There was legislation in 2020 that I know deferred require minimum distributions. I don't know if they specifically addressed that 3-year program or not. So I'm sorry, I can't answer that question, but if you can't get that answer from your tax advisor, somebody can email me or text me, and I'll look up that and see if there was a special holiday given to that 3-year program. The second part of the question, I think, if I heard it right, it was, what if you work in another state at home rather than New York State? Is that the question?
Yeah, let me reread it. What if you're working for a New York company from non-income tax state or vice versa?
Okay, if you're physically located in that non-income tax state, and that's where you are working from, then you're not going to be subject to New York State tax. But there's the if, ands, or buts in there, is how long did you work in New York before you started working in that non-tax state? You could still be dragged into New York, number one. And number two, did you work in that did you work at your own choice or because you had to? There's been tax court cases where, especially down in New York City area, you have people a lot of times that would work from home in Connecticut, New Jersey, etc. And New York has determined that if you did that on your own choice, not because of it was required by the employer, then you are still subject to New York tax. So, I'm sorry to be so vague, but that's the problem with both the IRS and New York tax law, is the if, ands, or buts of that. And so if your employer closed the office and mandated that you had to work from home and you lived in New Hampshire, then I think you can argue that you're not subject to New York tax during that period. But again, talk to your tax advisor, and this is a gray area of the law, and the if, ands, or buts, and it could be challenged by New York State. And sorry, I can't give more definitive answers, but that's the way tax law works.
Since we're on this topic of remote work and possibly working in different states, on a previous tax webinar last week that we were on, there was an insurance agent that also suggested some potential areas for tax savings would be to look at workers' comp insurance rate. So if we're paying people to work remotely, of course, an office assistant, the workers' comp rate wouldn't necessarily change because they're working home base. But if you're a contracting company or a manufacturer and people were working from home, wouldn't that affect potentially the workers' comp tax rate for potentially the few weeks or months that they were working from home?
Absolutely. She did bring that up. What Angela is saying is that if you had a carpenter that's a very high workman's comp rate, and you have them working at home doing administrative duties, then you should be making sure that you're only being charged the administrative work rate, not the carpenter's rate, because it's going to be a substantial savings in the amount of workman's comp that you pay. Okay. Any other questions before we go on?
No, we're in good shape, Doug. I appreciate it.
All right, and the last area we want to talk about is the business structure and the tax advantages. We're not going to get very deep into this because, again, the if, and, or buts hit, but just want everybody online to be aware of that. There are options as to how you operate your business and how it's taxed. We start out with sole proprietors. This is great for startups. We always advise to keep it simple. However, there's no liability protection with a real sole proprietor in operating. And liability protection is a legal issue, so I won't get into that very much. But as a sole proprietor, if you do get sued or you can't pay your bills, they can go after your personal assets. Partnerships, same thing. A general partnership has no liability protection. This is the default when there's more than one person. You have two or more owners. This includes if your spouse is legally part of your business, that's a partnership and it requires a separate tax return. And unfortunately, that tax return is a lot more complicated than a sole proprietor that reports on a Schedule C only the profit and loss on their 1040 tax return. A C corporation is a regular corporation that's taxed on its own profits. This is good for startups requiring large capitalizations, like manufacturing companies that have to buy very expensive equipment, and they have loans that they have to take out to buy that equipment. Usually those loans can be paid off under lower tax rates. The 2017 tax law reduced all corporate profits taxation down to 21% from a maximum of 35%. So that could be lower than the personal income tax rate, and you can take advantage of that by paying less taxes and paying off your loans quicker. However, the problem is that when you do have excess money and you want to distribute that out to the owners, there's a double tax. You're going to pay the corporate tax on the profits first, and then the distributions to the owners is a dividend that's subject to another tax. And that double tax could be higher than the personal income tax rate. So when you get into that situation, then you can elect to be an S Corp, and the profits are taxed on the individual tax returns. Once you pay that individual tax, there's no double tax on profit distributions. And the final entity choice is an LLC. That's a limited liability company. A lot of people mistake that C for corporations. That's not right. It's a limited liability company. And this is a true chameleon that can be any one of the above. It can be a sole proprietorship, partnership, a C Corp, or an S Corp, depending on how you elect to be taxed. And the LLC does put limited liability protection around a sole proprietorship or a partnership. So it is an entity that can be give you legal protection and eventually could give you some tax benefits, because you can change it from a sole proprietor to a C Corp or an S corporation just by filing one piece of paper.
So I love that you're ending on this segment, Doug, and I have a question for you. We saw very clearly in your chart earlier on that corporations can pay a lower tax rate. Is there still time, if I'm a sole proprietor or partnership, to file for corporation this year?
Well, first of all, in order to do that, if you're an LLC, well, to answer your question, not this year. Within 75 days of 2021, if you're an LLC, you can elect to be taxed as a C corporation or S corporation for 2021. So keep that 75-day window in mind. If you're just a plain sole proprietorship or a partnership, you cannot change to be a C Corp or an S Corp. You'd have to form a corporation and then transfer your business from your sole proprietorship or partnership into that corporation. Or you can form an LLC and then change that to a corporation in 2021. But you're too late to do that for 2020 at this point. And you know, if you formed a corporation by the end of the year, you'd only have those days going forward for this year, and that wouldn't be worth doing. So just to clarify, no, you can't do much of anything this year, but you can plan for next year. So this is good planning for next year. And the easiest way to change from a sole proprietorship and partnership is to either be an LLC now or form an LLC. But if you're going to do that for 2021, your tax advisor may say, forget the LLC, just form a new corporation and go from there. But again, talk to both your lawyer and your accountant on this one, because there's legal ramifications and there's tax ramifications.
And I know you can't give specific advice, but as a general rule, when is a company large enough to potentially consider forming a corporation? We know it costs a little bit more to operate. When does kind of the tax benefits of the added cost of forming a corporation kick in versus the self-employment tax that people pay on their net earnings when they own partnerships and sole proprietorships?
Right. Well, the C corporation, again, it depends on the business. But if you're going to be buying a lot of equipment and you're going to have to take loans to buy that equipment, you may want to be a C corporation right off the bat. For most businesses, keep it simple. Start out as a sole proprietor and do the LLC if you want the legal protection. But normally what I advise is once you reach the point of a reasonable salary for your industry, and normally that is the amount of money you need to take home to live on, and also you need to compare it to the industry. And usually if you get 20 or 30,000 above that in profit, then it's time to start thinking about whether or not you want to be an S corporation. And so I would say the rule of thumb is you know, a reasonable salary plus about 30,000 is when you start thinking. Certainly when you get 50,000 above that, definitely you should start thinking about an S corporation. But there's a lot of if, ands, or buts involved in that. So do the planning with your tax advisor to be sure on that.
Thank you so much.
You can see by the chart that we did that there could be significant savings by doing that. Okay. Do we have any other questions on the line or in the chat box?
We do. Angela, did you have any other ones you wanted to ask before I jump into that?
No, I'm good. I love that Doug ended on this topic. It's a topic we get lots of questions on. What should I be legal entity wise? And especially now we're talking tax strategy. So for the new years, that might be something that you want to look at. Too late to do anything about it this year, but for next year, there might be some opportunities. So, yeah.
It's a big opportunity, so definitely consider it. And hopefully with the vaccine coming out, everybody's going to be profitable for next year, right?
Let's hope. Yep.
Absolutely. I'll remind folks you can put any questions in the questions box and we will start answering those. You can also put them in the chat. It's also worth noting when we do shut down the webinar, you'll be prompted to complete a survey. We would love your feedback there. There's a few questions that are required by the SBA for us to ask, but whatever you're comfortable asking in that survey, we definitely like the feedback on how today's presentation went and future presentations that you might want to see. So please fill that out and we'll take a look at that after to review your feedback. Doug, for you, is there a type of CPA to work with on these specific tax items, or can you use a traditional accountant that you've been using?
I would say, you know, there's plenty of tax advisors and tax preparers out there that are not CPAs, and there's, you know, there's very good ones out there. So if you're comfortable with your tax preparer, continue to use them. It's you know, if you have any questions or you're not getting the answers that you think you should be getting, get a second opinion. We certainly do that quite often.
Great, thank you. Are employees who were quarantined while waiting for a negative test result included in some of the tax credits you reviewed?
Yes, if they have to stay home because of they have to be quarantined, that is a possibility. Again, look at the if, ands, or buts. But if they're required, if they were told by the county health department to stay home, then definitely they would qualify. And Dennis is shaking his head yes.
Yes.
I know it's an interesting setup that Doug and Dennis have going on where they are sitting next to each other, but on separate systems, but same audio.
Keeps me under control.
Absolutely. Angela, we should have coordinated something similar. I'll give folks another few minutes to put in some questions. Angela, I'll pick your brain a little bit. Can you talk about how folks that maybe are not currently clients of the SBDC can work with your office and kind of your relationship that you have with Doug and Dennis on getting some of these tax questions answered?
Well, hopefully I can sneak up an email to Doug and Dennis once in a while if we have a question, but just so everybody knows, SBDC does not provide tax or legal advice, so that is not the role that we play. The way we work with clients is one-on-one, much like tax rules, it depends, right? So we work one-on-one with clients to try and identify what you are working on and next steps to take. We can provide market research and provide you with good articles if you're interested in tax rules, but we will not provide you legal advice and tell you what to say or tax advice on what to do. During the pandemic, we've worked very closely with people to help them understand the programs, eligibility, what expenses are allowed, you know, the periods of times, even through the chaos when the programs were changing very quickly. We're still working with people to try and understand. And we've worked with some businesses where we run the numbers and you know what, you haven't quite spent down all your PPP. So that is absolutely something you can work with the SBDC on. If you need help doing budgets, right, because your sales are down, there are things that we can work on with you to help look at budgets to see if we might be able to change the business model to make things work. So really, it depends what you're trying to achieve. So what the best advice I can give folks is reach out to the SBDC. It is free to work with an advisor. And typically the first meeting's about an hour. We talk about your situation, what you're trying to do, identify next steps, and then we go from there. And sometimes one meeting is sufficient. And there's other clients we've worked with for hundreds of hours. So it really depends what you're trying to do. We work with startups. We work with existing businesses. We are working very heavily also on succession planning. Our baby boomers are retiring, new people moving to the region, looking to buy businesses. So there's lots of exciting things happening on that front as well. And Doug's going to partner with us on a couple different upcoming webinars for buyers and sellers and to talk about tax implications when buying a business, including legal structure becomes important. So
Awesome. Thank you.
There's no, you know, every question is welcome and we're happy to work with you at any point in your business, whether it's just an idea or you're a seasoned entrepreneur, just reach out.
Awesome. Thank you, Angela. I gave folks a few moments to type in some of these longer questions, so I do appreciate that. Also worth noting on the topic, most of our offices have resources like accountants in the area that we will provide. So if you're looking for a resource, a local resource within SBDC, there's typically a list that we'll share with folks in the area. All right, this one's from Daniel. No PPP was received for an LLC. They weren't eligible. They're a single owner entity. They received an EIDL loan. So is 100% of the EIDL taxable as income in 2020, or can any of it be spread out over subsequent years?
If they got an EIDL loan, that is not taxable. It's only if they got the advance, and the advance was only awarded on the number of employees that you had in 2019. So, or early, yeah. So, you know, if they had no employees in 2019, they didn't get an advance EIDL loan, but they got the entire EIDL loan, and that's not taxable, and it all has to be paid back.
Great, thank you, Daniel. If you have any follow-up on that, let us know. We did get a few questions asking us if today's recording and slides will be shared. We will provide that to you shortly after today. It will come from an email from GoToWebinar, and it will include the recording and the slides for folks. So a lot of these links within Doug's PowerPoint you'll be able to access there. So thank you for that question. So this is from Clay. We have an S Corp with 90% decrease in revenue this year and a large operating loss. We expect to recover revenues in 2021. Are there actions we can take to recover taxes paid in previous years and or carry forward losses to the future years?
Yes, Congress passed in the legislation this year prior to this year, you couldn't carry the losses back. You only could carry them forward. But they did allow the loss carry forwards and carrybacks. And so if you did pay taxes in prior years, you can carry that loss back and get some taxes back right away. The other planning is if you, let's say you didn't have taxable income in the prior years, you could elect to carry that loss forward and offset 2021 for that. Or if you don't use all that loss in a carryback situation, then it carries forward.
Great, thank you. Clay, if you have any follow-ups on that one, definitely let us know. Dennis from the chat, did I miss any questions? I'm just reading through this quickly, and I think we're in good shape because we answered them as we went. Doug, thank you for allowing us to interrupt you as we went along. But Dennis, did I miss anything?
Nope, the chat looks pretty clean. I think we handled them as we kind of got along, so we're good there.
Yeah, I'm sorry that we ran over, but I think it was good to ask those questions as we went along, and it was more appropriate.
Absolutely. And we do have a few more questions coming in. Greg asked, what is the amount of the tax carry forward loss?
The amount of the tax carry forward loss.
So,
well, if I understand the question right, let's say you had $100,000 loss this year. First, you would look back in the carryback portions, and I'm answering this, I think they said that you could carry it back 5 years. So if you went back to all 5 years and accumulated that, let's say the profits you had in those 5 years, and I could be wrong on that 5 years, but I'm doing it off the top of my head. But let's say you had all 5 years added up to 90,000, and you had 100,000 this year. First, you'd use the 90,000 up, and then you'd carry 10,000 forward. And I hope that answers Greg's question.
As we come to a close, Doug, is there anything you're watching that Congress might be discussing as the new administration comes in, or that we hope they'll be discussing shortly after the holidays that small businesses should be looking out for?
Well, not to talk negative, but Joe Biden in his last debate almost promised that he was going to raise tax rates. So if I heard him right, he first of all, he indicated that corporate rates, that 21% that we got reduced from 35% in 2017, he specifically targeted that as being raised. He did target capital gains, and he may be looking at personal income tax rates. So unfortunately, it may be bleak for tax savings for businesses.
What about a second round of PPP or any additional relief for small business? Anything, any rumblings, anything you're hearing in your network?
They've been talking a lot about the $1,200 that went to all the individuals. I think if you do see PPP type of legislation, it's going to be targeted to people that really lost money during the pandemic, that had to shut down, such as restaurants and theaters and airlines. Although the rumblings that I hear, it's going to definitely be directed to small business, because I heard 50 or 60% of the money in the first PPP went to large businesses, very large businesses. And anything that comes out, according to the rumblings I'm hearing, it's going to be more small business directed and to people that are really suffering in this economy.
Have you heard anything about maybe them considering allowing smaller businesses, for example, under $100,000, possibly changing the tax law where they would be able to take those expenses? Or again, I know you don't have a crystal ball. I'm asking in case you're hearing rumblings.
Yeah, unfortunately in Washington, they're being very quiet about it. But back in the summertime, they were talking about anybody under 150,000 would have a very simple application for the forgiveness. And the banks, some of the banks have been holding off, hoping that legislation would come through. But this IRS, as I said, only came out 2 or 3 weeks ago on the non-deductibility of the 2020 expenses. And there were several Congress men and women that spoke up and said they don't think that's fair. And that's was part of the law. But that's the only rumbling that I've heard about that. So it is possible that somebody will get that going, but let's keep our fingers crossed. Exactly.
One thing that we've said and we've heard about is contact your elected officials. They do listen to you as constituents. Doesn't hurt to reach out to everybody and say, I'd like this to be different, right? That's our process. That's why they're there.
Yeah, if you look
That's a
at
great point.
if you're looking at the example that I showed you, is anywhere from 25 to 40% or more of that money may have to be paid back to the government. That's good for the government, but that wasn't the intention of the government. It was to stimulate the economy and keep people employed. That's the good news. Some people actually lost money, like the example of that question that was asked on the sub-S corporation. So ultimately, they won't be hurt with tax if they lost money, if they really lost money. The people that made the profit, they're going to pay taxes, but hopefully they're still going to have cash in their pocket.
Thank you. We had a quick follow-up from Greg on the carry forward losses. Going forward, is there an annual cap on carry forward losses?
20 years.
Great, thank you.
If, off the top of my head, it fluctuated over the years, 18 to 20. I think the current law is 20 years that you can carry a loss forward before you lose it. And most businesses won't survive if they don't make a profit within 20 years.
Okay, thank you. That was the last question from my end.
Okay.
Excellent. Well, Doug, Dennis, Renee, thank you very much for helping with the webinar today. Doug, thank you as always for supporting small business and being available to us. And I look forward to our upcoming webinars on bookkeeping and tax planning when buying and selling a business. And also on January 13th, we will be doing a restaurant survival strategy webinar. We know this industry has been hit hard, so stay tuned. We'll be working again with Doug and the Hoffman Eells Group to bring some good information with regards to numbers in your business and some planning. So, well, everybody, and thank you again for attending today's webinar.